Before you invest a single rupee, dollar, or pound in 2026, pause for a moment and listen carefully. Because the biggest mistake most people make with money is not choosing the wrong stock or the wrong crypto or the wrong mutual fund. The biggest mistake is investing without clarity. People rush in because everyone else is talking about returns, screenshots, and overnight success. But smart investing has never been about speed. It has always been about direction. If you don't know why you're investing, what you're investing for, and how long you're willing to stay invested, 2026 will punish you financially. Markets don't reward excitement. They reward patience, discipline, and preparation. Let me tell you something very honestly. The world you are investing in today is not the world your parents invested in. Volatility is higher, information is louder, and misinformation spreads faster than ever before. In 2026, the biggest risk is not market crashes. The biggest risk is emotional investing. One bad headline can make you panic sell. One viral video can make you chase a hot trend at the top. If you cannot control your emotions, no strategy in the world will save your money. The first investment you must make is not in the market, but in your mindset. Learn to stay calm when everyone is fearful and stay rational when everyone is greedy. Before you put money into any asset, ask yourself one powerful question. Can I stay invested even if this goes down by 30 or 40%? If the answer is no, you are not investing, you are gambling. Real investors prepare for bad times before they happen. They build emergency funds, they manage cash flow, and they never invest money they may need tomorrow. In 2026, liquidity will be king. Those who respect cash will survive, and those who ignore it will be forced to exit at the worst possible time. Another hard truth you must understand is that returns are not guaranteed, but behavior is. Over time, your behavior will decide your wealth more than your intelligence. You don't need to predict the market. You need to manage yourself. Consistency will beat timing. Asset allocation will beat stock picking. And staying invested will beat chasing the next big thing. If someone is promising you quick profits with zero risk, they are selling dreams, not investments. In real markets, higher returns always come with higher uncertainty, and anyone who hides this fact is not being honest with you. In 2026, diversification will not be optional, it will be essential. Putting all your money into one asset because it worked in the past is a dangerous strategy. What worked yesterday may not work tomorrow. Smart investors spread risk across assets, across time, and across opportunities. They don't fall in love with one stock or one sector. They follow a process, not emotions. And they review their strategy regularly, not daily. Watching prices every hour will not make you richer. It will only make you anxious. Before you even think about charts, returns, or opportunities, understand this one truth that most people learn too late: the market doesn't destroy wealth. Uncontrolled emotions do. In 2026, information will be everywhere, opinions will be louder, and fear will spread faster than facts. One breaking news alert can make you doubt years of planning, and one viral success story can tempt you to abandon discipline overnight. If you don't control your mind first, the market will control your money. That's why the smartest investors spend more time building emotional strength than searching for the next big opportunity. Because opportunities come and go, but your behavior follows you into every decision you make. Think about this for a moment. Two people can invest in the exact same asset at the exact same time with the exact same amount of money and still end up with completely different results. Why? Not because the market treated them differently, but because they reacted differently. One panics during volatility, the other stays patient. One checks prices every hour, the other focuses on long-term goals. Over time, that difference compounds more than any return ever could. The market rewards those who can sit with discomfort without making impulsive decisions. If small price movements disturb your sleep, you are not investing, you are emotionally attached. Here's a hook you need to hear clearly. If a 10% fall makes you anxious, a 30% fall will break you. And in real markets, corrections are not a possibility, they are a certainty. The question is not whether volatility will come, but how you will respond when it does. Emotional control is not about ignoring fear, it's about acting rationally despite it. Professional investors expect downturns, they plan for them. They don't panic because panic was never part of the strategy. When you enter the market expecting only upward movement, every decline feels like a failure instead of a normal phase. Another uncomfortable truth is this: most people don't lose money because they chose bad investments. They lose money because they couldn't stick with good ones. They buy with confidence and sell with regret. They enter when headlines are positive and exit when fear is at its peak. This cycle repeats not because the market is cruel, but because human psychology is predictable. The market exposes impatience, insecurity, and overconfidence mercilessly. That's why controlling your mind is not optional, it's essential. Your portfolio will only be as strong as your ability to stay disciplined under pressure. In 2026, distractions will test you more than ever. Social media will constantly show you what you're missing out on. Someone will always seem to be making faster money, bigger returns, and smarter moves. If you compare your journey to theirs, you will abandon your plan at the worst possible moment. Remember this hook. Comparison is one of the most expensive habits an investor can have. Wealth is not built by reacting to others. It's built by committing to your own process and giving it time to work. Controlling your mind also means accepting uncertainty. You don't need to predict the future to succeed in investing. You need to prepare for multiple outcomes. The moment you demand certainty from the market, you give away your power. Strong investors focus on what they can control: their savings rate, their asset allocation, their time horizon, and their reactions. Weak investors obsess over predictions, tips, and rumors. One builds resilience, the other builds anxiety. Over time, resilience always wins. If you want to invest successfully in 2026, train yourself to respond, not react. Create rules before emotions enter the picture. Decide in advance how much volatility you can tolerate and stick to it. Remind yourself regularly why you started investing in the first place. When fear shows up, don't ask, "What should I do right now?" Ask, "What did I plan to do when this moment arrived?" Because moments of fear are not surprises, they are tests. And those who pass these tests quietly, patiently, and consistently are the ones who eventually see extraordinary results. Most people enter investing with one dangerous obsession: how much money they can make. Very few stop to ask a far more important question: how much money they can afford to lose without destroying their future. In 2026, this difference will separate survivors from victims. The market will always offer opportunities, but it will also demand respect. If you treat investing like a shortcut to wealth, the market will eventually remind you that shortcuts come with consequences. Protecting your capital is not about fear, it is about wisdom, because money that is lost cannot compound, cannot recover time, and cannot work for you again. Here's a hard hook you must accept early. You don't need big returns to build wealth, you need to avoid big mistakes. One reckless decision can erase years of discipline. Many investors spend months researching how to earn an extra 2 or 3%, yet ignore the simple habits that could protect them from losing 30 or 40% in a single bad move. Capital protection starts long before you invest a single rupee. It starts with cash flow control, emergency funds, and understanding the purpose of every investment you make. If your foundation is weak, no strategy will save you. One of the most common errors people make is investing money they cannot afford to lock away. They put their emergency funds into volatile assets, hoping for quick growth, and then panic when real life demands cash. In that moment, the market doesn't care about your situation. It forces you to sell at the worst possible time. This is not bad luck, it is poor preparation. Smart investors separate survival money from growth money. They understand that liquidity is not wasted potential, it is protection. In uncertain times, cash is not idle, it is powerful. Another hook worth remembering is this: risk is not the enemy, unmanaged risk is. Every investment carries risk, but not every investor manages it properly. Protecting capital means knowing exactly how much downside you can tolerate and structuring your portfolio accordingly. It means diversification, not concentration driven by excitement. It means saying no to opportunities you don't fully understand, no matter how attractive the returns look. In 2026, complexity will be sold as intelligence, but simplicity will remain the most reliable form of protection. Many people believe confidence comes from taking bold bets. In reality, true confidence comes from knowing you can survive worst-case scenarios. When your capital is protected, you don't panic during downturns. You don't obsess over daily price movements. You don't make emotional decisions under pressure. Protection creates psychological freedom. It allows you to stay invested long enough for time and compounding to do their work. Without protection, every market dip feels like a personal threat rather than a normal phase. There is also a silent danger in chasing high returns. It trains you to ignore risk. The more you focus only on upside, the more blind you become to downside. This mindset leads people into over-leveraging, speculation, and false confidence. They mistake a rising market for personal skill and forget that markets move in cycles. When the cycle turns, those without protection are forced out, not because they were wrong, but because they were unprepared. Protecting your capital means respecting the fact that you don't control the market. You only control your exposure to it. In 2026, the investors who build lasting wealth will not be the loudest or the most aggressive. They will be the ones who quietly manage risk, maintain balance, and stay patient when others are forced to exit. Capital protection is not glamorous. It doesn't make headlines, but it is the reason some people stay in the game for decades while others disappear after one bad year. When you treat your capital like your future instead of a tool for quick wins, every decision becomes calmer, smarter, and more sustainable. Most people believe wealth is created by how aggressively you invest, but in reality, wealth is protected long before it is grown. In 2026, the market will reward those who respect their capital and punish those who treat money casually. Here is a hook you must internalize early. If you lose your capital, you lose your future options. Money is not just currency, it is time, freedom, and opportunity stored in financial form. When you protect your capital, you are not playing defense. You are preserving your ability to stay in the game long enough to win. One of the biggest lies sold to new investors is that taking bigger risks automatically leads to bigger rewards. The truth is far less glamorous. Taking unmanaged risks often leads to permanent loss, and permanent loss is the only outcome that compounding cannot fix. You can recover from slow growth, but you cannot recover from reckless decisions that wipe out years of effort. This is why professional investors think first about downside, not upside. They ask, what can go wrong? Before asking, how much can I make? That single shift in thinking changes everything. Another powerful hook to remember is this: survival is the first rule of investing. Growth comes later. Many people invest money that should never be invested. Emergency funds, short-term savings, or money tied to future responsibilities. When unexpected expenses appear, they are forced to sell at the worst possible time. This is not because the investment was bad, but because the timing was wrong. Capital protection begins with separating money meant for safety from money meant for growth. When survival money is protected, your investments gain patience, and patience is what turns average decisions into great outcomes. Protecting your capital also means accepting that not every opportunity is meant for you. In 2026, you will see countless or once in a lifetime opportunities. Most of them will look urgent, exciting, and convincing. Here's the hook. Real opportunities don't pressure you, fake ones do. If an investment requires you to rush, ignore risk, or bypass understanding, it is not aligned with capital protection. Saying no is one of the most underrated skills in investing. Every time you avoid a bad decision, you quietly increase your long-term returns. There is also a deep psychological benefit to protecting capital that few people talk about. When your downside is controlled, your mind becomes calmer. You stop reacting to every market movement. You stop checking prices obsessively. You stop making decisions out of fear. This mental stability is not accidental. It is built through risk management. Investors who protect their capital sleep better, think clearer, and act more rationally. And over time, rational behavior outperforms emotional brilliance every single time. Another critical hook is this: confidence in investing does not come from boldness. It comes from preparation. When you know your losses are limited, you don't panic during downturns. You don't feel the need to do something. Every time the market moves, you trust your structure. This is why diversification, position sizing, and patience matter more than predictions. Markets will always surprise you, but they can only hurt you badly if you allow them to. Many investors confuse optimism with recklessness. They assume the future will always reward risk takers. But history shows a different pattern. Those who last are not the ones who chase every rally, but the ones who manage exposure wisely. Protecting capital is not about avoiding growth. It is about choosing sustainable growth. It is the discipline of respecting uncertainty, acknowledging what you don't know, and building systems that can survive mistakes. Because mistakes are inevitable, but financial ruin is optional. In the end, treating your capital like your future changes the way you invest. You become selective instead of impulsive. You become patient instead of anxious. You focus on consistency instead of excitement, and while others are busy trying to get rich quickly, you quietly build something far more powerful: financial resilience. In 2026, that resilience will be the true currency of long-term success. Most people think successful investing is about intelligence, timing, or secret strategies, but the truth is far simpler and far more uncomfortable. Wealth is built by ordinary actions repeated consistently over an extraordinary amount of time. In 2026, this reality will matter more than ever. Here is a hook you must remember: time in the market will always beat timing the market. You don't need perfect entry points or dramatic moves. You need patience strong enough to stay committed when results are slow and headlines are noisy. The market does not reward urgency, it rewards endurance. Many investors sabotage themselves by constantly searching for the right moment to invest. They wait for the perfect dip, the perfect news, the perfect signal. While they wait, time passes, and time is the most valuable asset an investor has. Every year spent waiting is a year of compounding lost forever. The power of long-term thinking is not that it eliminates mistakes, but that it reduces the cost of them. When you give your investments enough time, even imperfect decisions have a chance to work. Consistency is where most people fail, not because it is complicated, but because it is boring. Investing regularly, sticking to an allocation, and staying disciplined does not feel exciting. There are no dramatic stories attached to it. But here is the hook: boring strategies create extraordinary results. The market is full of people who made one smart move and lost everything later. It is far rarer to find someone who quietly invested month after month and ended up financially free. Consistency does not impress people in the short term, but it dominates in the long term. Long-term thinking also protects you from emotional decision-making. When your focus is measured in decades, daily volatility loses its power over you. A bad week stops feeling like a disaster. A bad year becomes part of a larger journey. This shift in perspective is powerful because it changes how you react. Instead of asking, "What should I do right now?" you start asking, "Does this change my long-term plan?" Most of the time, the answer is no. And that simple realization saves you from countless unnecessary mistakes. Another hook worth internalizing is this: compounding rewards patience, not brilliance. You don't need to outperform the market every year to build wealth. You need to avoid interrupting compounding. Every time you panic sell, chase a trend, or abandon your plan, you reset the clock. Time is not linear in investing. It is exponential. The biggest gains often come after years of staying invested, not from quick wins at the beginning. Those who quit early never see what patience could have given them. Acting consistently also means respecting a process rather than reacting to outcomes. Markets will test your faith regularly. There will be periods when your strategy underperforms, when others seem to be doing better, and when doubt creeps in. Here's the hook: short-term underperformance is the price you pay for long-term success. If you abandon your process every time it feels uncomfortable, you guarantee average results. Discipline is not about being right all the time. It is about staying committed when being right doesn't feel rewarding yet. Long-term investors understand that wealth is not built in one decision, but in thousands of small, correct behaviors. Saving regularly, investing systematically, reviewing calmly, adjusting slowly. These actions may feel insignificant on their own, but together they create unstoppable momentum. Over time, consistency becomes confidence and patience becomes power. The market doesn't care about your emotions, but it responds predictably to time and discipline. If you want investing to work for you in 2026 and beyond, stop trying to outsmart the market and start outlasting it. When others are exhausted by constant decision-making, you remain steady. When others chase excitement, you stay focused. And slowly, quietly, without drama, your commitment compounds into results that look impressive to outsiders but feel inevitable to you.